Welcome to the deep dive. We know there's just this constant flood of economic news data points.
Yeah,
It can feel like trying to find your way through a maze, right?
absolutely. It's overwhelming.
So our mission here is simple. Cut through that noise.
Yeah.
We want to bring you the really important insights, the nuggets of knowledge, so you can actually understand what's going on.
And importantly, why it matters to you.
Exactly. Today, we're diving into some really fresh macro data, stuff that's, well, it seems to be shifting the whole economic story.
Yeah, recalibrating things a bit.
We've pulled together a lot for this one, especially from the resurgent economy, market metrics analysis, and that crucial forward radar piece.
Good stuff in there.
So the mission for you listening is to get a grip on these core signals.
Right.
What do they mean? And maybe more importantly, what's coming up next that could really shape things.
Right, what to watch for.
Okay, let's jump in. Markets have just had this big wave of macro data to digest. And the reaction seems like genuine surprise out there. What's the big headline?
What's the shocker?
Yeah, what's really flipping the script on the economic conversation?
Well, the biggest thing, the real narrative shifter, it has to be the U.S. manufacturing PMI numbers.
Okay.
They didn't just creep above 50, they sprinted past it. First time in months we've seen that clear expansion signal.
Wow. Okay. So not just a little nudge.
No, not at all. A significant deviation from what everyone, well, almost everyone was expecting. And alongside that, yeah, we saw existing home sales bounce back pretty nicely.
Right.
And jobless claims ticked up a bit, sure. But really, it's that manufacturing signal that's making people rethink their assumptions.
Okay, let's unpack the manufacturing bit then. You mentioned PMIs, that above 50 line being critical.
Yeah.
Remind us quickly, what exactly are PMIs measuring? Why is 50 the magic number?
Sure. So PMIs, purchasing managers indexes, they're basically health checks for the economy.
Right.
They come from surveys of companies asking about things like new orders, output, employment, gives you a forward-looking snapshot. And 50, yeah, think of it like the water line. Above 50 means the economy is expanding, things are growing. Below 50 signals contraction, so hitting 50 plus is, well, it's the green light.
Got it. Green light for expansion. So what were the specific numbers that caused this surprise?
Okay, so the U.S. manufacturing PMI specifically, it surged to 53.3.
53.3. What was expected?
Forecast was 49.7. So yeah,
Right.
massive upside.
That is massive.
And it's more than just expansion. Historically, a jump like this is seen as a kind of regime change. It often points toward, cyclical acceleration.
A regime change. Interesting phrasing. What about services?
Services PMI, also strong, came in at 55.4, which was a modest beat against the forecast. Still very solid expansion territory.
And the overall picture, the composite?
Put them together, the U.S. S&P Global Composite PMI hit 55.4, also a big beat, and a new high. Really strong signal overall from the U.S.
That is powerful for the U.S.
Yeah.
But is this just an American story, or are we seeing this elsewhere? What's the global picture look like?
Yeah, good question. And what's really interesting, I think, is that it's not just isolated. Europe's composite PMI, for example, landed at 51.1. That's a solid beat. And their manufacturing PMI also just nudged over the line to 50.5.
So Europe's expanding too, manufacturing included.
Seems like it. A positive shift there. The UK also had a strong composite reading, 53.0. Big beat.
Okay.
But, and here's the nuance, the UK manufacturing PMI is still lagging. It's at 47.3. So soft, still below 50.
Okay.
Yeah.
So mostly synchronized expansion, U.S. and Europe. But UK manufacturing is the odd one out.
Pretty much sums it up. That broad move above 50, especially in manufacturing across the U.S. and the Eurozone, it really does suggest that those deep recession fears might be, genuinely receding.
That manufacturing jump, though, I mean, 53.3 after months below 50, it all sounds a bit too good.
It does raise questions about sustainability, for sure.
Yeah, how resilient is this, especially with, global stuff going on? And you mentioned labor cooling slightly. Let's pivot there. The labor market's been the rock, right?
Absolutely, the bedrock.
So what are the latest numbers telling us? Is it still rock solid, or are we finally seeing some cracks, some easing?
Well, that's where the nuance really comes in. You've got manufacturing lighting up, but the labor market, it's telling a slightly different story. More gentle easing, I'd say, not a dramatic drop-off.
Okay, gentle easing. How so?
So initial jobless claims, they came in at 235,000. That was a slight miss compared to the 226K forecast. But,
Broadly stable.
still low historically, right?
Very low, yes. Continuing claims,
Huh.
people still receiving benefits, they saw a gradual uptick to 1,972,000.
Okay, ticking up slowly. And another indicator, the Philly Fed Employment Index that specifically looks at manufacturing jobs, it cooled down. Went from 10.3 to 5.9. Still positive, mind you, still growth, but clearly not as hot.
Right, less heat.
So what this all points to, I think, is that, yeah, claims rose a bit, things are maybe cooling slightly, but these levels are still consistent with a slow, sort of controlled easing. It's definitely not a sharp deterioration.
Not falling off a cliff.
Exactly. Labor tightness is still there, absolutely, but you can see some easing around the edges.
So for someone listening, maybe they're looking for a job or thinking about changing careers. What does this gentle cooling actually mean for them? Is it still a good time?
I'd say, think of it like, okay, for months, the job market was like a completely packed train at rush hour.
Yeah.
Standing room only, maybe not even that.
Right, elbows out.
Exactly. Now, maybe we're starting to see just a few empty seats pop up. Not loads, but enough that it's maybe slightly less frantic.
Bit more breathing room.
Yeah, exactly. Opportunities are still pretty robust overall, but that intense, almost desperate competition might be easing just a touch. So if you're thinking strategically about a move, this kind of gentle cooling might actually be better than a red-hot market or obviously a collapsing one. It allows for a bit more thought, maybe.
Makes sense. Okay, from jobs. Let's talk homes. Housing. Felt like it was stuck in deep freeze forever.
It really did. Mortgage rates, affordability, tough stretch.
But are we finally seeing some green shoots? Is it thawing out?
Yeah.
Or is it still mostly stuck?
We are definitely seeing some green shoots. Yeah, genuine ones. Existing home sales, the actual number came in at 4.01 million.
Okay, 4.01 million. How does that compare?
That was a big beat. Forecast was only 3.92 million.
Ah, nice beat then.
And maybe more telling, look at the month-over-month change. Sales were up 2.0% in the latest figures.
That's the falling previously, right?
Exactly. They dropped 2.7% the month before. So that's a strong rebound, a clear bounce back.
So what does that bounce mean? Is the slump over?
Well, over might be too strong, but it definitely hints at stabilization. You know, after this really prolonged slump, seeing a bounce like this suggests we might be finding a floor.
A bottom, maybe.
Potentially. And that's key, especially for home builders, for mortgage lenders. It suggests we might be moving away from those big declines towards something a bit more stable, a turning point, perhaps.
So let's bring it back to the listener. If you're thinking about buying, maybe you've been waiting on the sidelines, or if you've wanted to sell but felt stuck, what's the takeaway here?
Well, for potential buyers, this could signal that maybe the worst of the volatility, the really sharp drops or uncertainty, might be easing.
Okay.
Now, it doesn't necessarily mean prices are about to boom or that affordability issues vanish overnight, but it points towards maybe a more predictable, slightly more accessible market environment starting to form.
And for sellers?
For sellers who've been waiting, this stabilization, this move away from the deep slump, it creates a healthier backdrop for actually getting a deal done. It implies maybe buyer confidence is returning a little, seller confidence too. It's about finding that new balance point, that equilibrium.
Right. Okay, so we've got these strong signals, manufacturing roaring back, housing showing green shoots, very positive.
Bullish alignment, you could say, in those areas.
Yeah. But then we have that slight cooling in labor, which you described as gentle. But you also mentioned the Philly Fed Manufacturing Index. That dropped significantly, right, to negative 0.3.
That's right, yeah, from 15.9 down to negative 0.3, big drop.
How does that square with the really strong national manufacturing PMI? That seems like a direct contradiction. Are parts of the economy just moving at different speeds?
That's a really sharp observation, and yes, that's exactly the puzzle. You have this bullish alignment, the big picture PMIs globally moving up, signaling expansion.
Synchronized expansion, you called it.
Right, but then you have these caution flags, jobless claims inching up, as we discussed. And yeah, that Philly Fed drop is a big one. It tells us that even within manufacturing, it's not uniform.
So maybe national strength hides regional weakness.
Yeah.
Or sector weakness.
Exactly. It suggests not all sectors, not all regions are in lockstep. It does kind of point towards a two-speed economy in some respects. Certain industrial areas or subsectors might be lagging even while the national headline numbers look good.
Interesting. So how does this play out in the markets? What sectors are benefiting?
Well, as you'd expect, the U.S. cyclicals think industrials, materials sectors that do well when the economy expands. They're catching a bid on these stronger PMI numbers. Investors are anticipating growth.
And the flip side?
Defensives, utilities, consumer staples. They could potentially lag if these recession fears really do continue to recede. Safety plays become less attractive in an expansionary environment.
Okay, now let's zoom out a bit. Beyond these specific data points, PMI, jobs, housing, what other big macro forces are swirling around right now that people need to be aware of?
Oh, absolutely. You can't look at this data in a vacuum. There are huge themes playing out.
Like what?
Well, AI, for one, the
Yeah.
impact on productivity, on earnings, it's massive. Then you have corporate earnings generally, which have been surprisingly resilient.
And valuations? Are markets getting ahead of themselves?
That's the question, isn't it? The S&P 500, for instance, is trading around, what, 22.3 times forward earnings?
Yeah.
Well, it's historically elevated. Frothy, some might say. So vulnerable.
Potentially. Wolf Research, for example, they've warned about possible seasonal volatility coming up. But countering that, you have these really powerful secular tailwinds like AI, like those strong earnings that seem to be putting a pretty firm floor into the market.
Okay, AI, earnings, valuations. What about the elephant in the room? The Fed.
Yes.
Yeah.
Crucial. Fed policy. And the timing here is key because today, August 21st, we're getting Fed Chair Powell's big speech from Jackson Hole.
Right, the annual symposium. Always market moving.
Always. And it could genuinely jolt expectations this year. Right now, markets seem positioned, broadly speaking, for the Fed to start cutting rates maybe as soon as September. That assumes the economy continues to cool enough.
But what if Powell doesn't signal that?
Exactly. That's the risk Barclays flagged. If Powell pushes back against those rate cut expectations, if the Fed sounds more cautious or hawkish than the market anticipates, you could see disappointment, maybe even a significant equity correction.
So a lot riding on Powell's words today. Huge amount. So if you step back and try to synthesize all this, the war in AI take, if you will,
Yes.
today's data really does feel like a new chapter, maybe flipping the script. Manufacturing's back, housing has green shoots, labor is cooling, but gently.
So optimism seems warranted, but fragile.
Precisely. Markets are positioned for that optimism, leaning into the expansion story, but that makes them vulnerable, especially to disappointment from central banks, starting with Powell today.
So what's the advice? Watch out for.
Definitely watch for volatility spikes around these central bank events. And keep a close eye on sector leadership. Are cyclicals continuing to lead? That would confirm the expansion signals are firming up. It'll be very telling.
Okay, super helpful context. So looking ahead beyond Powell today, what else should you, our listener, be keeping tabs on in the coming days? What's on that forward radar?
Right. The next week or so has some important stuff. The catalyst watch, let's call it. Obviously, keep tracking any fallout or further comments from Jackson Hole, not just Powell, but ECB President Lagarde, Bank of England Governor Bailey. Their speeches are major potential volatility triggers.
Especially if they sound different from each other or from Powell.
Exactly. Divergence from market expectations is key. Then, looking at data, we've got durable goods orders coming up and also consumer confidence.
Why are those important now?
They really set the tone for those cyclical sectors we talked about. Big misses or big beats in durable goods or consumer confidence, that can pivot risk appetite really quickly.
Got it. Anything else specific in the U.S.?
Yeah, a few more housing indicators, building permits that affects housing stocks and REITs, real estate investment trusts.
Right.
Then new home sales key for the home builders directly. And besides the main durable goods number, there's core durable goods orders, which strips out volatile transportation stuff. Also important for cyclicals and sentiment.
And consumer confidence impacts.
Big impact on consumer discretionary stocks, things people buy when they feel good about the economy.
Okay. Anything outside the U.S.?
We should probably keep an eye on the RBA. That's the Reserve Bank of Australia. Their meeting minutes are due. Gives a sense of broader sentiment, particularly in the Asia-Pacific region.
So plenty to watch to see if this new narrative holds.
Absolutely. These next few data points will be crucial tests.
Well, there you have it. A really deep dive into this shifting economic picture. We've covered that surprising manufacturing rebound, the hopeful signs in housing, and that more nuanced, gently cooling labor market.
Lots of moving parts.
Indeed. And hopefully this discussion has helped you cut through some of that complexity, understand the core signals, and maybe pull out some insights that are useful for you.
Making sense of the maze.
That's the goal. So as you wrap up listening and go about your week, maybe here's a final thought to chew on.
Okay.
Given these pretty significant shifts we've discussed, the data surprises, the looming Fed decisions, How might your own perspective on the economy's resilience, on where things might be headed, how might that change?
Yeah, how does it affect your outlook?
And what could that mean for your own plans, financial planning, maybe even career thoughts down the line? Something to mull over. Keep connecting those dots.
Keep watching the data.
We'll be here next time to help you make sense of whatever comes next.